Here is the FX market response update for Monday, June 29th. Last week, an agreement of some sort was signed between Israel and Lebanon. Around the same time, there was an exchange of hostilities involving an Iranian attack on a Singapore-flagged vessel and a U.S. strike on coastal areas along the strait. These events have cast further uncertainty over ceasefire negotiations. Nevertheless, crude oil prices continue to be driven by market expectations. U.S. stocks, Bitcoin, and gold prices have continued to decline. While this is often attributed to market caution regarding the future outlook for AI-driven yields, rather than the ceasefire talks, I surmise that the primary cause is the unwinding of yen carry trades in the U.S. market following the Bank of Japan's interest rate hike. Regarding major fundamental factors last week, the outlook for U.S.-Iran ceasefire talks, compounded by the exchange of attacks between the two nations, has become increasingly clouded with uncertainty. Yet there has been no official statement declaring the end of negotiations. One must ask, do the attacks on tankers, military facilities in the strait, and U.S.-stationed bases fall within an acceptable range? The crude oil market continues to trade on optimism. However, a crucial point is that even if the Strait of Hormuz remains open, national stockpiles are dwindling, and inflation is rising in countries that are key links in the supply chain. In other words, the dynamic of weakening currencies in minor economies versus strengthening major currencies is only just beginning to intensify. Given the persistent upward pressure on the dollar, this trend is unlikely to reverse. We are now seeing a marked decline in the U.S. stock market. To understand this situation, one need only consider the dynamics of Bitcoin, BTC, and gold, XAU, to narrow down the scope of analysis. In particular, persistent strong selling pressure remains in the cryptocurrency market, while the price of gold has stalled. Furthermore, the drop in U.S. stocks is not due to the lackluster future returns of AI stocks, a narrative often cited by the U.S. media. Instead, the primary cause appears to be the unwinding of yen carry trades in the U.S. market. The root cause of all this is the Bank of Japan's interest rate hike. When the Bank of Japan raised rates last year, the market reacted exactly as theory predicted. The yen appreciated against the dollar. Subsequently, Governor Ueda refrained from further rate hikes. During this interim period, U.S. stocks, cryptocurrencies, and gold prices repeatedly hit new highs, demonstrating that the interest rate differential between Japan and the U.S. was being maintained. The scale of the yen carry trade in U.S. financial markets is massive. Essentially, one can view this as Japanese holdings of U.S. treasuries being leveraged to fund dollar-denominated investments collateralized by those very bonds. This mechanism is driven by the interest rate differential between Japan and the United States. While financial institutions from both countries are the actual investors, the arrangement effectively functions as a reverse repo transaction involving government-held U.S. treasuries. This dynamic was sustained by Japan's decision to postpone interest rate hikes while U.S. Treasury yields remained above 4%. However, as public opinion in Japan increasingly called for a rate hike, the Bank of Japan began making sporadic comments hinting at further increases. These remarks served as a warning to the U.S. government and financial institutions. Subsequently, the United States launched an attack on Iran. Around that time, U.S. inflation began to accelerate, triggering a rally that pushed U.S. stock prices to new highs. The yield on the 10-year U.S. Treasury note hit 4.6% and then hovered just below that level. A further rise would have widened the interest rate differential between the U.S. and Japan, causing the yen carry trade in U.S. markets to balloon even more. Meanwhile, the Federal Reserve grew wary of potential interest rate hikes in Japan. Faced with mounting inflationary pressure, the Fed became increasingly reluctant to cut rates. At the June FOMC meeting, the decision was finally made to hold rates steady and maintain a policy of monetary tightening. Notably, gasoline prices had climbed above $4 per gallon by June, up from under $3 per gallon in February. However, President Trump desired a weaker dollar resulting from interest rate cuts, a stance that diverged from the Fed's established path. Yet, Warsh, the new chair nominated by the president, maintained the FOMC's existing course while separately initiating an injection of liquidity into the market. This was triggered by a public leak regarding a potential interest rate hike at the Bank of Japan's June meeting, effectively flashing a red card at the interest rate differential. A reduction in yen carry trades flowing out of U.S. financial markets inevitably impacts stock prices. Indeed, such an impact has already materialized. To plug this liquidity gap, the new chair, Warsh, is scrambling to inject liquidity into the system. Yet, the slide in U.S. stock prices continues unabated. A significant portion of the capital flowing into U.S. AI stocks originates from SoftBank, the quintessential private sector player in yen carry trades. However, the sheer scale of this exposure means the Bank of Japan's path toward higher interest rates deals a near-fatal blow. Naturally, skepticism regarding the future returns on AI investments is mounting. Compounding this is the volatility in crude oil prices, driven by uncertainty surrounding the outcome of ceasefire negotiations. What convinced me of this was Governor Ueda's absence due to illness from the Bank of Japan's monetary policy meeting in June. After all, a Bank of Japan meeting is an event that commands global attention, even more so than sessions of the National Diet. The world scrutinizes every single word uttered by the governor at the press conference immediately following the meeting. The schedule for these events is set well in advance, yet news of the governor's hospitalization broke at the last minute. Doesn't that strike you as odd? In all likelihood, there was pressure on the Japanese government from the United States. Unable to alter the meeting's outcome, the Japanese government may have orchestrated a move to keep Governor Ueda from the post-meeting press conference, thereby stifling any comments regarding the Bank of Japan's path toward raising interest rates. The U.S. has requested that Japan intervene in the market to buy yen, but Japan has been slow to act. I believe the U.S. envisioned a package deal combining liquidity injection with Japanese intervention to sell dollars. The urgent proposal I posted on X on the 27th was based on my anticipation of this package. Without such a move, incoming Chairman Warsh's liquidity injection would continue, causing the Fed's balance sheet to expand further. Arab currencies do not include the ILS or TRY. Regarding the ceasefire talks between the U.S. and Iran, a military escalation has ensued following violations of the agreement by both sides. Currently, the price of WTI crude oil has fallen below $70 per barrel. Hopes for a market recovery are now hanging by a thread. While GCC pricing remains relatively high, Gulf prices are expected to lead a future rise in costs. However, this scenario presupposes the continuation of ceasefire talks, and the current escalation is undermining that very premise. The prospect of Iran assuming control over the Strait of Hormuz, a major shift regarding this international waterway, is a notoriously difficult issue within the ceasefire negotiations. Even if the ceasefire talks do progress, any security arrangement excluding the U.S. could potentially result in a strategic landscape defined by an encirclement of Israel. In the Asia-Oceania region, Australia often takes the lead among ASEAN nations in response to pressure trends originating from China. However, India's influence has also been growing recently. Regarding the situation last week, China, the most influential player, shifted from a state of sustained buying pressure to a condition of slight selling pressure, effectively reaching a state of equilibrium. Concurrently, selling pressure from Australia intensified. Currencies in Singapore and Hong Kong moved in tandem with U.S. buying pressure, while currencies in countries like Indonesia and the Philippines exhibited selling pressure that reinforced the U.S. buying trend. While the number of currencies contributing to U.S. dollar buying pressure is expected to rise, it is certain that the loss of buying momentum from China played a significant role in driving U.S. buying activity. Last week, the dollar's core trend once again showed buying pressure, aligning perfectly with the charts. The PTN counts for the various currencies indicate an overwhelming dominance of PTN3. Furthermore, the yield divergence adjustment has significantly encroached upon PTN2 territory. To clarify, within host PTN1, PTN3 signals a buy, whereas within host PTN2, PTN3 signifies a sell. The euro continued to face selling pressure last week. As the currency most directly opposed to the US dollar in trading, the euro's decline has significantly facilitated the dollar's appreciation. This trend is driven by the fact that the US economy is more robust than Europe's. A fundamental reason for this disparity is energy sourcing. While the US is an oil-producing nation, Europe, having lost access to Russian supplies, relies heavily on the North Sea and the Middle East. There is deep concern regarding the Strait of Hormuz, a critical supply route from the Middle East. While capital had been flowing back into the Eurozone last year, the conflict between the US and Iran reversed this trend, triggering selling pressure. In reality, this shift stems from inflation driven by crude oil shortages. Essentially, it reflects a rise in the price of goods exported to the US. News reaching Japan rarely covers these aspects of the European situation. Instead, the narrative focuses on the shift from supporting Ukraine to directly attacking Russia, highlighting how EU totalitarianism has entered a phase of controlling its member states. Issues regarding immigration and agriculture go largely unreported. The ECB raised interest rates at its June meeting. Inflation within the Eurozone is being overheated by rising import prices, driven by a direct crude oil shortage resulting from a blockade of the Strait of Hormuz, amidst a US-Iran conflict and the collapse of global supply chains. The ECB has effectively been a global leader in raising interest rates since last year. However, unlike last year, when rate hikes were expected to drive euro buying, the currency is now facing selling pressure despite the same rate hiking environment. Europe is also being subjected to an extraordinary heat wave, which is damaging grain crops and the energy sector, including crude oil operations. While Europe has relied on crude oil supplies from the US, these are projected to decrease in the future. Europe continues to face a growing economic burden regarding immigrants and refugees. Both the EU and NATO are currently attempting to court Japan as a new source of funding, a move that has drawn expressions of displeasure from the United States. Last week saw continued selling of the euro for the second consecutive week. However, the aggregate data reveals that the core trend is actually one of buying, contrary to the current selling pressure. This is because Europe itself is directly involved in the supply chain issues. Domestic inflation is overheating, and export prices are rising. At the same time, the region is facing higher import costs resulting from the breakdown of global supply chains. While I bought into the dips last week, the current upward selling might represent a minor market adjustment. Here is an analysis of the macro environment and domestic/foreign affairs affecting the British pound sector this week. On the foreign affairs front, the opening of sea lanes following the signing of a US-Iran ceasefire memorandum has eased geopolitical risks. This has exerted decisive downward pressure on persistent UK price trends through a sharp drop in crude oil prices. The domestic stock market remains resilient, buoyed by cost reductions resulting from the normalization of supply chains, while the unemployment rate holds steady within a stable range. Given these clear signs of cooling inflation, the stage is being set for the Bank of England, BOE, to shift its monetary policy stance from maintaining high interest rates toward cutting rates sooner than anticipated. Last week, the pound saw buying on dips. Over the past 4 weeks, the market has alternated between buying and selling. However, the core trend indicates buying on dips, despite occasional spikes in the opposite direction. Last week, the renminbi, RMB, showed signs of slight selling, a pattern somewhat similar to that of the British pound. On the external front, the sharp drop in crude oil prices following the US-Iran de-escalation has exerted downward pressure on import prices. Meanwhile, on the domestic front, the real estate market slump and persistent deflationary pressures remain significant headwinds. In response to these challenging economic conditions, the People's Bank of China, PBOC, is shifting its monetary policy stance, moving away from excessive tightening and toward a more flexible approach that accommodates liquidity injections and a market correction, reversion to the mean. With attention focused on a potential breakout from the limit convergence zone on the index chart, the RWCNY recorded a 0.05% move this week. This suggests a growing possibility that the excessive buying pressure accumulated against a basket of major minor currencies is beginning to unwind. Last week, the Chinese yuan turned blue on the PTN1 chart for the first time in a while. However, the core indicator in the summary section continues to show buying pressure. This implies that there is selling pressure on the currency pairs involving the yuan. This means that even though the PTN has changed, the core trend remains unchanged. Last week saw a marginal net buying of the Japanese yen. This figure includes buying driven by the repatriation, or unwinding, of yen carry trades from U.S. financial markets, a topic we discussed in the dollar table session. However, I surmised that there was an equivalent amount of yen selling. The net figure of minus 0.14 represents the difference between the two, indicating that buying barely prevailed. The yen selling I just mentioned implies the existence of an equal amount of selling pressure across currency pairs, corresponding to the aggregate core value, buying pressure derived from the periodic table model. This can be understood by examining the currency pair indices in the flow statistics. Needless to say, this selling reflects the depreciation of various currencies caused by the collapse of global supply chains resulting from crude oil shortages. In last week's FMR 6.15, I reported, based on unverified social media posts, that President Trump had approached Prime Minister Takaichi regarding a Japanese contribution of $150 billion for Iran-related guarantees. However, that figure was a mistake, and the correct amount was $15 million. I apologize for the error. The Takaichi administration readily agreed to shoulder this burden, becoming the first nation in the world to contribute funds. Meanwhile, as of today, the Strait of Hormuz is on the verge of closure. Japan indiscriminately hands over taxpayers' money, derived from the blood, sweat, and tears of its citizens, to the US and the EU. It is an abnormal situation. Japan long ago exhausted its capacity to make global contributions. Ideally, such costs should be covered by the industrial sector via Keidanren, Japan Business Federation. No other country in the world bypasses the intermediaries to place the burden directly on the public like this. Dispatching the self-defense forces is sheer nonsense. Last week, the Japanese yen registered as PTN2. The core section of the summary indicated strong buying pressure. Consequently, the inverse pair showed strong selling pressure. This indicates significant currency depreciation among supply chain nations. Let us clarify a point here. A Lindex pair represents the differential between two Lindex values. For PTN1 and PTN2, reversing the pair results in the same differential value, but the sign, positive or negative, is inverted. In other words, the buy/sell roles are swapped. When viewed on a chart, looking from the currency with higher pressure to the one with lower pressure reveals a spread, the differential, representing the relative strength of the former. Conversely, looking from the lower pressure currency to the higher pressure, one shows the latter as relatively weaker by that same differential. Thus, the core figure in this summary indicates buying pressure for pairs where the Japanese yen is the base currency, while signifying selling pressure for the inverse pairs. Thank you for watching. Have a wonderful week. This has been Taro Tanabe reporting from Japan.